America didn't fall into the Great Depression slowly. It collapsed fast. In less than 4 years, the richest country in the world fell into breadlines, bank runs, and mass unemployment, and the same pattern that caused it is quietly forming again today. In 1929, Americans believed prosperity was permanent. Stock prices kept rising. Ordinary people borrowed money to invest, convinced wealth no longer came from making things, but from owning assets. Risk felt small. The future seemed certain. Then, in October, 12 million shares were sold in a single day. Within weeks, billions of dollars, equivalent to vast fortunes today, disappeared. Banks failed, jobs vanished, families lost their homes. Most people believe the Great Depression was caused by the stock market crash. That's wrong. The crash was only the moment the illusion broke. As economist Irving Fisher explained in 1933, the more the debtors pay, the more they owe, describing how excessive debt and deflation can intensify financial collapse. World War I ended in 1918, and the United States emerged transformed. Unlike Europe, America's cities, factories, and infrastructure were untouched by war. While much of the world was rebuilding from ruins, America was positioned to supply it. Millions of soldiers returned home to an economy that appeared unstoppable. Factories that had been producing weapons shifted almost overnight to consumer goods. Plants that built tanks began producing automobiles. Steel mills that fed the war machine turned toward household appliances and construction materials. At the same time, social structures were changing. Women who had entered the workforce during the war didn't leave when it ended. Two-income households became more common. More workers meant more wages, and more wages meant more spending. This period became known as the Roaring Twenties, a decade defined by optimism, consumption, and confidence that prosperity had become permanent. Technological breakthroughs accelerated the feeling. Henry Ford perfected the moving assembly line, allowing him to mass-produce the Model T at prices ordinary Americans could afford. Cars reshaped daily life, cities expanded outward, suburbs grew, businesses no longer needed to cluster near rail lines or city centers. Electricity spread rapidly. Radios entered millions of homes, creating the first mass media culture. Vacuum cleaners, refrigerators, and washing machines reduced manual labor and freed time. Companies made fortunes selling convenience and modernity. America wasn't just producing more, it was producing differently. And for a while, that production supported real growth. But growth planted the seeds of something else. Banks watched this boom closely. Rising incomes, steady employment, and expanding industries made lending appear safe. If the economy kept growing, borrowers would always be able to repay. Credit began to flow freely. Loans were extended to households, businesses, and speculators alike. Buying something no longer required saving first. You could borrow against future income. Installment plans allowed families to purchase cars and appliances immediately, paying over time. Credit works when tomorrow reliably brings more income than today. And during the early 1920s, that was true. Spending fueled growth. Growth encouraged optimism. Optimism justified more borrowing. The problem wasn't credit itself. The problem was what credit slowly began funding. Instead of being used primarily to expand productive capacity, factories, tools, infrastructure, credit increasingly flowed into asset ownership. Buying things that already existed became more profitable than creating new things. That shift was subtle at first, then it accelerated. As Americans watched their incomes rise and their neighbors get richer, a question quietly spread through society. What do you do with extra money? The answer increasingly was the stock market. Stocks became the symbol of modern wealth. Prices climbed month after month. Newspapers ran stories about ordinary people becoming rich. Dinner conversations shifted from wages and work to tickers and tips. Owning stocks wasn't just profitable, it became a social signal that you understood the future. Soon, participation spread far beyond professional investors. Taxi drivers, waiters, factory workers, and shopkeepers all entered the market. Even shoeshiners were known to give stock tips. The belief took hold that markets only moved in one direction, and that anyone who stayed out was missing an opportunity that might never come again. Then leverage entered the picture. Buying on margin allowed investors to borrow money to purchase stocks, using the stocks themselves as collateral. With only a small amount of cash, someone could control a much larger position. A person could put down $10, borrow $90 more, and control $100 worth of stock. As long as prices rose, profits were magnified. Rising prices made leverage look safe. Gains were celebrated. Losses were dismissed as temporary. Very few people considered what would happen if prices moved in the opposite direction. Banks didn't just enable this behavior, they embraced it. Some banks lent aggressively to speculators, assuming rising prices would protect their loans. Others went further, quietly investing depositor funds directly into the stock market without disclosure. Deposits that people believed were safely stored were being used as fuel for speculation. Between 1922 and 1929, stock prices rose more than 200%. On paper, America's wealth doubled. But underneath the surface, the real economy began to weaken. Factories produced more goods than consumers could afford to buy. Wages stopped rising. Inventories piled up. Automakers reduced output. Corporate profits flattened, even as stock prices continued climbing. The connection between production and prices broke. People weren't getting richer because more value was being created. They were getting richer because prices were rising, driven by borrowed money chasing assets rather than funding real output. Stocks no longer reflected economic reality. They reflected belief. By this point, everything looked strong on the surface, but the foundation underneath was already cracking. If this is starting to sound familiar, stay with me and subscribe for more clear explanations of how these economic patterns really work. By late 1929, cracks were visible. Interest rates rose as banks struggled to attract deposits. Corporate earnings failed to justify stock prices. Industrial production declined. Then, in October, confidence snapped. On October 24th, 1929, Black Thursday, selling erupted. Investors realized prices had detached from reality and rushed for the exit simultaneously. 12 million shares traded that day. Ticker tapes lagged hours behind actual prices. People sold blindly, unsure what they were receiving. Panic fed on uncertainty. Markets stabilized briefly over the weekend, supported by hope and promises from bankers. That hope collapsed on October 29th, Black Tuesday. Selling became relentless. Prices plunged another 12%. Billions in paper wealth disappeared. Investors who bought on margin were wiped out instantly and still owed their loans. Entire portfolios vanished. The crash didn't end the economy. It exposed what had already failed. As the Economic History Association explains, by the time the crash was completed in 1932, following an unprecedentedly large economic depression, stocks had lost nearly 90% of their value. The real damage began after the crash. Banks had tied themselves directly to speculation. When stock prices collapsed, the value of their investments evaporated. At the same time, loans made to speculators went bad as borrowers lost everything and defaulted. Banks were never designed to survive that kind of shock. Banks don't keep most deposits in cash. They lend them out, investing in loans and assets while holding only a small fraction in reserve. Under normal conditions, this works because not everyone withdraws their money at once. But after the crash, fear replaced trust. Depositors didn't know which banks were exposed and which were safe, so they lined up at all of them. Even healthy banks faced runs because no bank could meet mass withdrawals simultaneously. When one bank failed, it didn't calm the system. It terrified it. People rushed to withdraw their savings before it was too late. Each withdrawal weakened banks further. Each failure made the next run faster. Money that represented years of labor vanished overnight. Families lost savings without ever having invested a single dollar in stocks. Safety itself became an illusion. As banks failed, credit disappeared. Businesses that relied on short-term loans to operate couldn't access cash. Payrolls were missed. Suppliers went unpaid. Companies closed, not because demand vanished, but because money stopped circulating. A vicious cycle took hold. No credit meant no spending. No spending meant layoffs. Layoffs meant even less spending. Failures multiplied. By 1933, 1 in 4 Americans was unemployed. The Dow Jones continued falling for 3 more years, eventually losing 90% of its peak value. Thousands of banks collapsed. Homes were foreclosed. Farms were seized. Cities filled with breadlines and soup kitchens. The system didn't pause, it reversed. Debt that seemed manageable during the boom became unbearable during contraction. When incomes fell, repayments failed. When repayments failed, banks collapsed. When banks collapsed, credit vanished. Each failure fed the next. The future that Americans had borrowed against finally arrived, and it demanded payment. Government intervention attempted to slow the collapse. Franklin Roosevelt's New Deal introduced public works programs, financial reforms, and relief efforts. These measures reduced suffering and restored some confidence. While they stabilized the patient, they couldn't cure the disease. Private debt still outweighed productive capacity. Businesses were cautious. Consumers were fearful. Banks were defensive. Growth stalled because trust had been destroyed. The economy didn't rebound quickly because debt doesn't disappear when optimism does. It lingers. It constrains decisions. It turns risk into danger. Throughout the 1930s, recovery remained fragile. Any improvement was slow and uneven. Confidence never fully returned. It took the outbreak of World War II in 1939 to finally absorb the unemployed. Massive government spending on weapons, logistics, and infrastructure restarted production at scale. Factories ran around the clock. Jobs returned, not because debt was resolved, but because production exploded. The Great Depression didn't end through healing, it ended through mobilization. This collapse wasn't unique to America, and it wasn't a one-time mistake. The stock market crash of 1929 was not the sole cause of the Great Depression, but it did act to accelerate the global economic collapse. The same pattern has appeared again and again throughout history. In the Dutch Tulip Mania of 1637, easy credit pushed prices of tulip bulbs far beyond anything they were worth. People borrowed money to speculate, convinced prices would keep rising. When confidence broke, prices collapsed almost overnight. The same thing happened during the South Sea bubble of 1720. Cheap money fueled wild speculation. Share prices rose on promises instead of real profits. When those promises fell apart, the market crashed and the economy followed. Japan repeated the pattern in the late 1980s. Cheap credit drove land and stock prices to extreme levels. Wealth looked endless on paper. When lending tightened, asset prices collapsed and the economy entered decades of slow growth and stagnation. The sequence is always the same. Credit expands, spending rises, speculation replaces real production, prices drift away from reality, then confidence breaks. Debt that once felt harmless pulls the system down. History doesn't change the machine, it only changes the actors. History doesn't repeat itself exactly, but the conditions that lead to collapse often look familiar. In recent years, borrowing to invest in financial assets has increased again. Asset prices have risen faster than the underlying earnings and production that support them. More money has flowed into stocks, real estate, and speculative investments than into expanding real output. This doesn't mean a collapse is guaranteed, but it does echo the same conditions seen before past crises, when credit grew faster than the economy and confidence became detached from reality. Every major financial breakdown began the same way. Optimism replaced caution, debt replaced income, and rising prices replaced real value creation. Debt still follows the same math. Production still sets limits. And when those limits are ignored, systems eventually correct themselves. The Great Depression wasn't a failure of one decade. It was the result of a pattern that forms whenever belief outruns reality. The Great Depression wasn't caused by a single crash. It followed a pattern. Credit expanded, debt replaced production, speculation took over, and the system collapsed under its own weight. That pattern has appeared many times in history, and it always ends the same way. The names change, the technology changes, the mechanics don't. If this helped you understand how economic collapses really work, like the video, subscribe for more clear explanations of history and money, and share it with someone who still thinks crashes come out of nowhere.